Hello and welcome to this week's Market Matters weekly video update for Thursday the 27th of October. I'm Harry Watt, joined by James Gerrish. Lots to talk about today, James. Pretty fascinating time in markets. We're off the back of reporting season. We're into AGMs, quarterly updates, everything going on, and the ASX is punching near-term highs at the moment. What's your take on everything that's happening market-wise?
You're not wrong, Harry. A hugely fascinating time in markets, and we've got this. Whilst earnings are really important, we've had those. The majority, or they're dropping at the moment over in the US. We've had AGM season and a bunch of trading updates coming out here in Australia, and of course, central banks are really in focus. So, obviously, rate increases on the back of inflation that's still coming in higher than many expected it to be. Yesterday here in Australia was an example of that. So a lot playing out. I think, to simplify it down, I think, we've written about this a lot. Our positioning in our Across the Market Matters portfolio supports this view. We've got a view that the market is too negative at the moment, positioned negatively. Everyone's underweight equities. Everyone's citing the huge amount of economic challenges that are playing out right across the board. And I'm not downplaying that, but I think the market positioning is such that less bad news, we're going to see some really strong buying. We think there's early signs that bond yields have peaked. We think there's early signs that interest rate rises may not be as aggressive now as they have been in recent months. And when you get a pivot like that, a pivot overlaid with such bearish positioning across what fund managers are owning and not owning, and the cash levels and the like, then you set up for what can be a pretty meaningful rally in the market. And we're positioned for that. We're expecting the market to be sort of 7,200 on the ASX 200 around Christmas time. We're an outlier in that. It's a contrarian call, but you don't make money following the crowd in this market. I think that's probably the message I'll leave it with, Harry.
It's not that big a call anymore, though, James. We made that call a few weeks ago, and it's already rallied, and we're only sort of 400 points away, less than 400 points away from that 7,200 marker now, James.
Yeah, exactly right. 68.50 we are on the market today, and even the market today is a really good example. The spot US markets were sold off pretty aggressively at the back end of last night's session. There was all reason for us to sell off this morning. We didn't. Even weakness across the banks, which we're going to get onto, has been bought into. So to me, I think there's just a few signs building up to say that the market is more likely to go high because buyers have been exhausted. Sellers have been exhausted, I should say. You
made mention of the banks today. ANZ reported today. They're the first of the three of the big four that will report in this period. James, what's your take on that result? It did open up. It was up early. It got down to about 6% lower pretty early on as well, and then it's sort of recovered a little bit of that. What's the take on that ANZ result and the reaction from the market today?
So I read through the numbers first up, and they look good. A couple of things I'd highlight is sort of top line revenue growth was strong in the second half, and the elusive net interest margin expansion that everyone's been sort of looking towards. As interest rates rise, then banks can increase their margins because there's a discrepancy of when they hike interest rates on borrowers versus passing it through to depositors. So there was some optimism built after Bank of Queensland's result that was going to come to pass. It has. So the net interest margin, particularly the exit margin. So yes, the second half exit margin was above where the market was expecting it to be. So therefore, naturally, you will probably get upgrades coming through tomorrow. What the market didn't like was some talk about costs. On the conference call, Shane Elliott was talking about a pretty difficult next 6 months, and probably the cost. The introduction of higher costs was probably a bit of new news in terms of the ANZ results, and that's why I think it got sold down, very aggressively this morning, down from down 6%. It's now down about 3% at the moment. So I thought it was a reasonable result. I think he's been conservative in his guidance. He's obviously stating the obvious that we're in for another challenging 6 months, but markets tend to look 6 months out at least. And don't forget the banks did run pretty hard into this result. So look, I think it was a fine result, and I wouldn't be too concerned about the 6% decline early, and that's why it's bounced back late in the session.
Yesterday morning, our morning report, we wrote about our top picks across the portfolios, James. So really good report for subscribers to go onto the website and have a look at. We're going to read between the lines a little bit on that report and dig down. We didn't really give an over-the-top view, but we did give stock-specific stuff. Firstly, there were 2 property stocks in that report overall. Is that sort of a theme that we're now looking at and going a little bit more aggressive at? Goodman has been pretty weak, as has Centuria, and they're sort of our 2 top picks. Does that mean we're bullish on property moving forward?
So, we've got 4 equity portfolios that we run, so we put 3 stocks out of each, so 12 top picks. So if you're looking for some high conviction plays, then jump onto the Market Matters website and have a look at that report. It was probably more of a coincidence that 2 property stocks are there, but I think it brings up a good point around we think the property sector collectively is oversold, and if our macro views come to pass around interest rates and the like, then property should do better than it has done over the past 12 months. But the 2 stocks we've picked, they have a degree of ability to help themselves. So what I mean by that is, you've got a lot of real estate investment trusts which own assets. A lot of those are trading below their NTA. So for them to go and do something, they need to raise capital, issue shares, and they're reluctant to do that when they're trading it below the asset backing of the vehicle. Whereas Goodman and Centuria are the 2 stocks we made mention of. They've got different areas to their operation, so they go and do deals. They can take advantage of what's played out in property, the depressed valuations out there. That's probably the main reason why we've gone with those 2. We hold Centuria in our income portfolio. We hold Goodman Group in our flagship growth portfolio. And as I said, they're self-help stories. They're great management. We're backing management to take advantage of the conditions we're seeing. Whereas a typical real estate investment trust is going to be less able to take advantage of this weakness.
One other key message, well, not message in the report, as a message that was missing, there was no resource stocks across the board. You think 12 top picks, it's not often you would see 12 top picks and not put a resource stock in there. Is that should subscribers read between the lines and extrapolate that into a more bearish view of resources here, James?
No, they shouldn't. It was I read the report after it was out, and that was something that became obvious. We haven't picked a resource stock, and I guess we've got the stocks that we've chosen are we're most bullish on here and now. I think different parts of the resources sector we're bullish on. So we've got some copper exposure in the Market Matters growth portfolio. We've got lithium exposure, rare earths exposure. So it's about buying things here and now. So is Pilbara, Linus, IGO, which are the stocks in that part of the market we've got exposure to now. Am I going out there and buying those? They're at really high levels. Linus is probably a little bit different there, but so it was all about here and now. We think the beaten up technology, the beaten up high valuation growth is going to do better in the short term. So that's what that report was all about. I think iron ore is a little bit muted at the moment. Copper's obviously coming off a reasonably low base. It's trading sort of mid-range. So we're 50-50 in the short term in terms of that. I think it'll do really well over the next 12 to 24 months, but a little bit muted more in the short term. So and if we get these recessionary fears come to pass, then resources are growth focused, so there may be some if interest rates are going lower because economic conditions deteriorate a little bit, then you've got the premise or the belief in the market that the demand for resources may be a little bit more tepid in the short term. So that's the reason probably why they weren't featured as much in that report. But I did note we wrote about gold stocks today, Harry,
and coal as well,
so we mused around whether or not coal was a sell and gold was a buy. I think coal, there's so many strong tailwinds for that at the moment, but gold, I think the macro backdrop around if the US dollar's peaked, if interest rates peaked, gold has been just completely unloved. The gold stocks have been unloved more. And we can see a reasonable bounce coming out of that sector leading into Christmas.
Bit of a rally today on the back of that report, James, particularly those gold names.
Absolutely. It was all about the Market Matters report this morning.
The emerging companies portfolio, specifically, the 3 stocks there, all came out with good updates in the last couple of weeks. You think Calix, they had a couple of raise and a deal. Aussie Broadband's AGM and Audinate's AGM as well. Their updates there were a little bit better than the market expected, and we have seen the stocks pop a little bit on the back of that. Are we reading into that? Are we buying things that put out good news, or are we chasing weakness here?
Well, we're putting out things that they have been, the majority of those stocks have been weak in recent times, but they've come out and sort of allayed some of the market fears around what's been driving the weakness. So that was certainly the case in Aussie Broadband. I don't think it's going to, I think some of the concerns coming out of their full year results have been allayed. So the fact they've come out and updated the market, I think that shows a degree of confidence. Audinate came out and said some really strong things about their business. They've rallied as a consequence. But I like information in the smaller emerging part of the market. It's your portfolio that you're managing. I think it's information is really important. So we want to see how these companies are doing. So those three companies that we made mention of have given recent updates. They've all been positive, and that's why we're backing those into the back end of the year, Harry.
Certainly. That's all we've got time for today. Thanks for joining us, James. I hope you guys got something out of that video.